Welcome to Wealth Unfiltered, your go-to source for industry insights and wealth creation. Stay ahead of the curve with a thorough breakdown of market trends, financial developments, and the impact of current events on your wealth building strategy. We deliver the latest updates and essential insights into the financial world through expert interviews and detailed analysis. Hi there, and welcome to Wealth Unfiltered. This is our newest episode on the top 10 biggest investment mistakes and how to avoid them. My name is Samantha Parrinello. I am your host for this evening, and my co-host / resident expert is Chris Parrinello.
Hey, everybody.
How are you doing tonight?
I'm doing well.
Excellent. So normally what we do is we jump in, we start having a slight discussion, but there's a lot of information that I want to cover today. So instead of having the small chit chat, I want to get right to these investment mistakes because I think that this is probably one of the episodes that is going to be the most impactful for people of all types of investors, whether they are seasoned or not, because there might be some things that we bring up that they've not thought about, maybe they haven't paid enough attention to, or really for people who are brand new investors, this is going to help you through your investment journey from start to finish. This is really how to make less mistakes throughout the entirety of it from start to finish.
Yeah, and there's so many different elements of who you are as an investor to where these could apply to real estate investments, they could apply to building a portfolio, they could apply to being active versus passive. So
just to give a little bit of context, Christopher and I discussed, some of the biggest mistakes that he sees, right? You are the director of investor relations for Viking Capital, and you talk to people every single day. So you've not only seen it with investors who've told you about things that have gone wrong in their other deals, it's things that you've neglected. You've said, I'm not going to make these mistakes as an expert in the field. Is there any more context you want to give to why we're doing this episode?
No, and I think, yes, I'm the director of investor relations for Viking Capital, but I've been in private equity for almost a decade, from international, investments to hotel development. There's lots of things that I've seen that when I saw them, I didn't even necessarily know that they were mistakes, but my experience has taught me, pretty valuable lessons.
Amazing. So one of the first topics, I should say, one of the mistakes that people make is the lack of clear planning. So we're talking about the very beginning of investing. So the mistake is they invest without a defined plan, strategy, or outcome. So what would be ways that you would suggest that they avoid that mistake?
Yeah. So I think there's a few answers to this question.
Absolutely.
So the first one is a broad plan, which is, okay, I make this much money, I have this much in savings. I know I want my money to work hard for me so I can work less and over time build wealth. How much do I want to put out? What things do I understand? Where can I make good decisions? Who do I need to lean on? What books do I need to read? That type of planning should always come first. Always, I would say, and even when I'm telling, investors that I've met for the first time, we should always be somewhat skeptical and really understand what's going on. Anyone that you're putting investment dollars with should be willing to explain things to you and make you feel comfortable. And if they don't, it's a high pressure situation where they're just trying to get you to invest, then it's probably a bad choice.
Yeah. And I think making sure that all of those factors that you're talking about align with the goals that you set out. So each investment that you're looking for if you're saying, I want to have more time freedom, then you might want to have more passive investments than you do active investments. You're trying to build wealth faster. You might try to take a little more high risk.
Or if you like to have more control, and maybe you like to have control and you have time and you're really passionate about real estate or day trading or whatever it is, and you're willing to put in the time to learn everything about it, then usually if you add in your sweat equity plus whatever dollars you have to invest, you're going to get the highest ROI by combining your sweat equity with the money that you have. If you have to start relying on other people to do most of the work, you still are responsible to figure out how the investment works so you don't end up in making bad decisions. But once you find some reliable people and you test things out and you feel comfortable that you're not taking on too big of a risk, you can really, multiply your wealth that way too.
Well, and speaking of risk, one of the best ways to try not to have as much of it is using the tactic of diversification. So that brings us to our second mistake, which is insufficient diversification, when people are allocating all of their funds into one asset class or just a really small amount of investments.
Yeah. And I think more isn't always better. So the idea behind diversification is that you're pairing different investments or different asset classes to where it's really a hedging situation. So it's like, okay, I'm not necessarily just focused on yield. I do want to have back end upside in whatever I'm investing in. But maybe if you're primarily in stocks, you have some stocks that are producing yield but aren't going to grow as fast. You have some that could explosively grow, but they might not give you any yield. But combined, you have a certain amount of yield that you've been able to dollar cost average and kind of create a risk adjusted strategy to where not only are you fulfilling the requirements that you want for having income, but you're also setting your sight on the horizon and you're taking some more calculated risks.
So how does diversification protect investors, like their portfolios, from like a downturn?
Yeah. So if you're broadly diversified and you've put some thought into it, or you've worked with a financial advisor and they've been helping you choose how to diversify, usually you're not going to see some major unexpected event hit multiple different asset classes or sectors. You could even diversify within a sector. So like, for instance, like when I talk to investors at Viking, we might have, like currently, we have a deal that's in Dallas. We have a deal that's in a suburb of Atlanta. I had an investor the other day ask me, which one's better? I'm like, loaded question, right? So in my opinion, it isn't so much which one's better. One produced much more yield. One was a 3-year hold versus a 5-year hold. It really needs to pair with what they're looking for. Are they okay with their entire money being at risk and illiquid for 5 years versus 3 years? So a lot of this nuance became the conversation to help them understand the decision they were making. But at the end of the day, my suggestion to him was, if you're looking at investing $100,000, why don't you put some in each asset and load the one, if you're yield focused or if you're time focused, maybe do 75-25 in either one. And when you're looking at a broader portfolio, it's the same kind of idea. You wouldn't want all of your investments to be in the stock market, because if all of your investments are in the stock market and some massive thing happens like a COVID or something like that, and everything goes down 30 or 40%, you don't have a hedge against that. Now, like I always go back to what I know best, which is, real estate, specifically multifamily. In 2020, when COVID hit, people that were investing in multifamily from 2015 to 2020 experienced the opposite of what the stock market was going through, because inflation was driving up rents and money was pouring into multifamily because institutions understood that it was a good hedge against inflation too. So that was a really good time to already be in that asset class. And for people that hedged, they might have seen a dip in their portfolio in the stock market, but a huge growth spurt in deals that they invested in 2016, 2017, and then exited in 21 and 2022.
Yeah, having, I feel like, a long approach, but really not being short-sighted when it comes to investing,
right?
And knowing that even in the stock market, I mean, for us, the same years you're talking about, we had money in stocks and we saw them plummet, just like everybody else saw them plummet. And, we decided that wasn't what we needed to invest in at the time. We just held on to those and waited out until now, right? Where things are going back up, and you see the ebb and flow of what a market does.
Well, and the idea is that you don't wait for the disastrous thing to happen in the market to diversify into something that isn't disastrous, because the time to invest in the market was when it was disastrous.
Right.
So if in 2015 you were 50-50 diversified, one in real estate and one in the stock market, and you see massive losses in the stock market for whatever the reason is, I would even divest some of the thing that is on a rocket ship and producing great yield and great returns and put it in the thing that's suffering, because you're probably getting the best value that way.
Right. You've actually, I think, used that specific phrase on every episode so far, is the importance of finding value. Most people, when they search for investments, I don't hear a lot of people use that word. Maybe they're thinking it, but I think people are looking for upside. They're looking for risk management. They're not looking for value. And I think if more people started shifting their mindset a little bit more to that, they might surprise themselves at what they find.
Yeah, 100%. And I think that it's harder to not do the obvious thing.
Definitely.
So if it's obvious, then chances are you missed the boat. So you're trying to figure out and build because diversification, there's a lot of timing elements into it as well. And there's certain, we talked about this on the last episode, but there's a frothiness to a market. And when something gets really frothy, like we're just talking about multifamily from 2015 to 2022, 2022 to 2024, or 2021 to 2023, some of those deals didn't really make sense because of what was going on in the market and how hot it got. So you never want to completely pull out of a market, especially one that you've dedicated time and resources into learning and understanding. You want to trust the fundamentals, but at the same time, you really want to kind of control the timing. And there's going to be times where you want to put a lot of your resources there. And there's going to be times where you want to take a step back and say, okay, well, maybe there's some better value here. And I'm going to wait until I can get better value there, because most of this stuff is cyclical.
Absolutely. So you actually, it's like you're reading my mind or something, but yeah, I'm like, can you see my notes? Why do so many investors fall into this next trap, which is this other mistake of trying to time the market? They are basically trying to like follow the trends and what they think is going to happen instead of like using caution.
Yeah. I mean, I think it's framing, right? I think to a certain extent, any sophisticated investor is trying to time the market. And the better you are at timing the market, the more success you're going to find. But you can't fall into the trap into believing. It would be like me saying, I'm going to bet on sports. And because I know so much about sports, I'm going to be able to tell you every single team that's going to win or going to lose.
Right.
Like the cycles aren't that automatic to where if it was easy to time the market, then no one would make any bad decisions and everyone would only make good decisions. But it tends to be that like if you feel like something's overvalued, chances are that it is. And the way that you can tell if something is overvalued or not is you kind of look at the trends. So like with the thing that I intimately study on a daily basis, multifamily is kind of based off of kind of where cap rates are. Mm-hmm. So it's always important to create NOI, to have occupancy, all of these things. But the biggest thing when you look at a performer or a model that's going to dictate how much value you can appreciate the asset is going to be in what cap rate environment are you going to be able to sell. And it's hard to tell. You can think one thing's going to happen. And then, I think a lot of people were really bullish that interest rates are going to come down really quickly. And they've, come down, but not very quickly. People couldn't time COVID. So knowing that COVID was going to happen, like there are little things that when you think that you just have a plan and it's going to come right, that are going to turn you a curveball. And that's why it's important to diversify and have a long-term strategy. Because if you didn't believe in the fundamentals of multifamily, then you wouldn't want to put any money there.
Right.
So if you don't believe in the fundamentals of Bitcoin, regardless of how successful it is, like you shouldn't probably put money there because you don't understand what needs to happen or what could happen to disrupt that market. And I think that that's the big thing is there's all these kind of hidden disruptors that aren't quite so obvious that are going to affect the cycle and maybe elongate a cycle or shorten a cycle.
Yeah, this cycle in particular, I feel like people are very surprised by. It's going much slower than anticipated originally. So I think this is a very good just example of what you're talking about.
When I think people also, myself included, sometimes misread a cycle. So sometimes you're following a set of data and you're like, oh, this makes total sense. Interest rates are going to come down and they have to come down because if they don't come down, people can't afford to do this and this. And the US has this giant balance sheet and they're paying higher. And then when it comes down to it and you listen to the Fed chair speak, he's like, well, the economy's strong and people are spending money and inflation isn't quite where we want it. So like from an economics, academic standpoint, you're like, no, it makes sense. Like if I were him, I wouldn't lower interest rates either. I would wait for something to show some imbalance or some kind of stressor that would say, oh, like we really need to lower rates. But
he's like the chess player who's waiting to make the move based off of the other opponent almost.
Well, it's an incredibly hard job because the moves that he makes, everyone wants him to act very rapidly. But my argument would be that the way that they moved so rapidly in 2020, because they knew that they were going to have to drive up rates to combat inflation, that took everyone by such surprise because it was such a massive hike in interest rates so quickly that people that thought they had contingency plans didn't.
Right. There was no way. Yeah.
And I think that was my argument where like I'm in an industry where everyone, you watch the news, you watch what the Fed's doing and you're kind of hoping for interest rates to come down. I've always, if you've seen any of the webinars we do for Viking, like I'm always the contrarian. I'm like, it's like, would rates make this particular deal would do better if we had like a 5.25% rate instead of a 5.5%? Maybe. But rates staying elevated create value for us to get deals at a lower price.
Right.
So there's always two sides to a coin. My gut is telling me that the company I work for and other real estate private equity firms out there, if you have flexible equity, you have the ability to purchase deals, you're going to get a much better basis in an environment like this than in an environment where interest rates are very low. When interest rates are very low, then everyone's going to do the obvious thing and buy deals, and cap rates are going to compress. And if you're smart, you're probably going to sell everything you have and not buy as much. To be very selective about what you're buying, because if you believe in the fundamentals, you should always continue buying, even when you're at the top of the market. You're just much more selective about what it is.
That makes a lot of sense. I will say that one of the things that I don't think that you mentioned the specific word that, and is something that I think is really important, like last piece to that is the consistency. You're kind of like touching on like you should never stop, but really the consistency of investment, especially as like an LP style investor, right? Making sure that maybe what you do is you set a goal of however many investments you want per year and making sure that you're sticking to that to help diversify, but then also make sure that the timing of the market isn't such like an impactful piece in case there is a downturn, making sure that you're always in the action.
Yeah, 100%. And that's what I tell the folks that come and invest with us at Viking. I was like, I would much rather you put a smaller amount in several deals across a spectrum, and we can talk about each one and what would need to go right and what would need to go wrong, than for you to put all of the money that you have to invest into one deal and just hope that that deal does really, really well.
Right.
That's just, you're playing the odds and you're taking a big risk, hoping that you're going to get a big gain. If you look at like the track record for Viking, if you were in Viking's worst deal, or you were in a small amount spread across all 26 deals Vikings done, you would have a better outcome being in all of the deals. If you were in Viking's very best deal versus all of the deals, you would have done better than the average, but it wouldn't have been as significant.
Right. Well, and I think we should probably just say that Viking's worst deal is not that bad. Like in the scheme of what's going on right now.
To date, its worst deal was a return of capital and a very small return, like an annualized 3% year over year for a 3-year hold. And it was a deal that they bought before COVID that dealt with an eviction moratorium. It's understandable. Like, I think there were reasons why it didn't work. But to give you an idea of timing, they sold that deal in 2021, the beginning of 2021, coming out of COVID, when they were able to get NOI up enough to where they could return capital. And they had a partnership.
So no money lost is what you're saying.
No money lost. So a pretty nice floor. But the dynamics there was a partnership group, and that partnership group had control of that particular deal, which is uncommon to Viking, and they wanted to sell. Had they held on through 2021 and 2022, those investors would have had much better returns, because that was when the market really took off and when cap rates really compressed. So selling...
having patience.
Having patience.
But that's also difficult, I would say, when you're dealing with hundreds of investors versus it just being your own thing that you're investing in, getting to make that decision.
Correct.
Yeah, that's tough. So that brings us to our next mistake. So one of the most, I would say probably top 3, you can tell me if you agree or not, is not assessing your risk tolerance and understanding how to align your portfolio within that.
Yeah, no, 100%. I think risk tolerance is incredibly important. And the way that I would define it is, if you look at investments that have 0 to no risk, and I always use US Treasury bonds because the US government has never defaulted on a Treasury bond. So that's considered a risk-free asset. And then you look to something that's like super speculative, that is like, I don't know, like a penny stock or something that like is only worth a penny. But if every little thing goes right, it could be worth 100 pennies and you 100x your money. You're basically throwing your money away. Or, so you want to find yourself somewhere in the middle and then figure out, like, that's why it's so important to construct your portfolio based off of what you have as far as incoming capital, what kind of liabilities you have for yourself as far as your net worth. And then there's a certain amount of money that if you lost it, like you would be unfazed. And with that money, you'll take the most calculated risk. It'd still have to fit within your risk profile.
Yeah.
So nobody wants to lose their money, right? So like you wouldn't just take all of your savings and go to the casino.
I was about to say, unless you're trying to go to Vegas, maybe.
I'm going to play blackjack. But there are people that love to gamble that make lots of money or a little amount of money. And there's a certain amount of risk tolerance to where they're like, well, I'm going to play the slot machine or I'm going to play blackjack. And they look at the odds and they enjoy it. So if your risk tolerance is, I'm going to spend $200 at the casino, but this is entertainment, and if I lose everything, I'm fine, then That's your risk tolerance. $200. You could win a lot. You could lose everything. And then there's going to be a subset of your portfolio where risk tolerance is different. And like I always look at it kind of like a planet. Like you have a core, and that should be where you have the least amount of risk. That could be bonds, that could be preferred positions in equity investments. And then as you go out, you build that core and you have enough to where you feel like you're able to take slightly more risk. You build another layer onto that core. Be like, okay, I think that this is slightly riskier than that, but I'm getting this extra upside. And then once you build a solid enough foundation for your portfolio, you're able to take on more risk. And it also dovetails with, hopefully, as you're investing in things, you're learning more about them and you're measuring your successes and your failures. And you're saying, okay, I invested in this. This is what was going on. This is why it failed, or this is why it didn't do as well, or this is why it did 10 times better than what it did. And that's all data that you should be tracking and using to build into your portfolio construction. If you have a year where you made a lot more money than you thought you were going to make, you can take some bigger swings of the bat. And it's always, in my opinion, the long game. So if you're ever trying to make the most money you can make in the shortest amount of time, and that's your goal, you're setting yourself up for a disaster. So you usually want to build a long-term approach to building wealth, and taking advantage of your most valuable tool is time.
Yeah, absolutely. I love that. So our next mistake is chasing performance. So what they mean by that is, like the phrase is, investing in assets that have recently performed well and you're expecting them to continue that same growth trajectory.
Yeah, I think, obviously this goes back to the answer I gave earlier, kind of a value. You want to invest in things that are going to perform well, obviously. So you're not going to shy away from high performing companies or high performing assets or asset classes. But you do want to consider that if something has performed so extremely well, how much more runway is there for it to continue to have that same breadth of performance?
Can you give us an example of like either a stock or something that people would invest in that this has been the case?
Yeah, I'll give you a few examples. So a stock, I would say look at something like Tesla or Nvidia. Should you put money there and continue to put money there? Yes, I think that both of those have great long-term horizons. Should you expect the growth that you saw over the last 10 years? No. I think that they've hit their meteoric rise and now they're still great value for a portion of your portfolio. But if this is going to be your largest swing of the bat, there's probably better value. I was having a discussion with someone about Bitcoin and other types of other cryptocurrencies that have like a usefulness to them. And one was called Solana and the other one was called Ethereum. And I'm not expert at cryptocurrencies.
I haven't even heard of those yet.
much exposure here. The way it was explained to me was that Ethereum was really, really popular. And I was like, well, where's the risk? Like, why would, if it's a better value and it still could hit the growth of Bitcoin, explain to me why you would put money in Bitcoin and you would put here. And apparently another coin came out called Solana, and Solana had a lot of what Ethereum did, but it could do it quicker, faster, cheaper. So even in cryptocurrencies, there's other coins that are going to come out that achieve the same goal and can do it quicker, more efficiently, cheaper. You can invest in the one that has proven to be successful, but if you want to chase like an alpha return or like a really, really big, strong, no one saw this coming return, you're not going to be able to do the obvious thing. So that doesn't mean don't invest in the obvious thing. I think you should. There should be a portion because the obvious thing is going to carry less risk and offer less reward. And that's, I think, the important thing to remember about risk. And I know I've said it before, even in these first few episodes, risk isn't always a negative thing. You just want to make sure that you're protecting yourself and you're hedging your bets so you're insulated and that you can take more deeper swings of the bat and get better returns that are risk adjusted, of course. Take your experiences and what you've learned and build a strategy around that.
Well, and I think that comes to the next topic, which is kind of like understanding balance. So one of the things that gets missed, a mistake that people make, is being overly confident. So instead of having the risk reward balance sheet, saying, okay, like I'm willing to have a little bit of risk here because I really believe in this or that, people go in and they start making some wins and then they get overly confident and then they forget about risk altogether. And that is also a very common mistake that people make. So I would ask you, how can investors strike a balance to mitigate that risk?
Yeah, I think, and the way that I refer to balance is harmony. So
Okay.
I think what you're looking to do, the only way that you're going to be able to achieve that is to ask yourself in any investment that you're investing in, honestly, like what could go wrong? What's the worst thing that could happen? Where is the risk? How am I mitigating against it? And a lot of people, I know people that will reconcile and do a deep dive on deals that have gone poorly. I know even less people that do a deep dive and try to figure out exactly what went right on deals that overachieved. And I think it's
It's a good point.
equally, they're both important because those dynamics are going to be the lessons that help guide you in any future investment that you're making.
Yeah, absolutely. I love that actually. That's a really great mindset to have. So, the next two topics that are mistakes that people make, I probably would say they have some of the most negative impact that can happen. And the first one is avoiding or ignoring tax implications.
Yeah. And I would even venture to say that one of the worst mistakes that you can make is purely focusing on tax implications.
Both. So,
I think,
it's like definitely twofold here.
right. It's multidimensional for sure because a lot of people get caught up in tax strategies are great. The IRS tax code is robust and there are strategies that you can employ based off of, call them loopholes, but they're really ways in which you tend to never be able to get out of paying taxes. There's lots of ways that you can defer taxes, kick your tax burden down the road. And anytime you can kick your tax burden down the road, you're able to grow your money tax-free. If you can grow your money tax-free, then it's going to grow quicker than if you were paying tax. So I talk to investors about this a lot. And a lot of times folks will ask me, well, which deal produces the most bonus depreciation? Or in my world, it's passive losses that they can use. And I try to push them from like, that's important, but the viability of the deal is more important. Even if it's two of our deals, forget comparing against someone else's deal. There's also, some really speculative, tax play you invest in.
I'm sorry, say that again?
Really speculative like tax plays where you're investing in like oil and gas and you can write off 100% of your tax liability. You're not avoiding those taxes. You're just kicking them down the road. And if they don't strike gold with the oil, then, you might not have a viable investment. So I always tell people that you should evaluate the investment based off of its fundamentals. And if you can use it as a tax strategy, that's a bonus.
Absolutely.
And if you are investing for purely tax savings, then you should go to the most risk averse. So like when I'm dealing with an investor, I tell them we have a product called Class A where you give up back end equity and you're getting a higher yield. And you're taking less risk, so you're getting less return. So if someone told me like I'm only investing for the passive losses, I'd be like, I would say get in Class A, get your prioritized cash flow, reduce your risk as much as possible. You're going to get the passive losses either way, but now you're reducing your downside risk because usually when people are investing based off of wanting to offset tax, they're so focused on that, they're not evaluating the investment.
True. That's the inverse piece, but the other piece is if you don't pay attention to the tax implications, then
you're just leaving money on the table.
You're leaving money on the table.
For sure.
Absolutely. And you may think you even are making something you're not making. It's full circle.
And you can think about it like we have that same example. We have investors that invest, millions of dollars in each deal, and they're getting a $500,000 tax write-off or a $700,000 tax write-off on certain deals. And they're able to offset $700,000 of passive income and use that money right now. So if you had an extra $700,000 to invest and you don't have to recapture any of that for 5 years, think about how much money that $700,000 is going to make over the next 5 years. And that's all essentially free money.
Right.
And then when you get to 5 years where you recapture, most of those people are going to kick the can down the road and try to offset it another 5 years through something like a 1031 or finding more bonus depreciation.
Yeah.
And the tax code allows for it. It is what the wealthiest people in the country are doing.
Well, and compounding your wealth, right?
And you're compounding by there's another sage lesson from my dad about the time he told me about miracle of compound interest. He taught me about miracle of 72. And you basically take the interest rate, you divide it by 72, and that tells you how many years it will take for your money to double. So if you were getting a 10% interest rate, 7.2 years, you are going to double your money. And if you look at, I said earlier, your most valuable resource is time. Your time horizon is how many years you're going to be able to double your money over time. And if you ever take out a calculator and just do 1 times 2, 2 times 2, 2 times 4, whatever, and you multiply over and over and over again, doubling your money, pretty soon you're going to break the calculator and it's not going to be able to tell you how much money you have.
So, it's a good problem to have.
So if you can teach somebody that when they're really young and that person understands the value of saving money and having the money work for you, it kind of sets them up for success because the younger you are, the longer your time horizon typically.
Yeah, absolutely. I love it. I love it. What a great insight. So that brings us to the other one that I was going to say, which is, I think, a huge misfortune if people don't realize that this is a big mistake, and it's not rebalancing their portfolios. So rebalancing is when you buy or sell so that you can realign your portfolio back to like your risk tolerance, your asset class like preferences, right? So what happens when this goes left unchecked?
Yeah, I mean, I think, in many cases, it could be perfectly fine. And what you're losing is opportunity. In some cases, you could get into liquidity issues. The biggest companies in the world, spend a lot of time, especially, big corporations, balancing the balance sheet, having several companies. Like if you think of like a big company that owns lots of other companies, what are they doing? They're diversifying.
Absolutely.
And they're saying, okay, well, not all of these companies are going to fail at the same time. So if this company is really strong and we can get these, it'll give us time to get these over working better, more efficiently.
Makes me think of what's the company that Alex Hormozi and Layla have?
Acquisition.com.
Yeah, like what you're talking about right now, like reminds me of like kind of like their theme of what they do.
Vikram took us all to a workshop there and we got to meet with them and kind of go through both his companies, Viking Capital and Limitless MD. And it was fascinating to see some of the companies that they advise on and their approach. Even if you're not looking at like a company that owns multiple companies and you're just looking at your own portfolio, you want to invest and divest. And this kind of went into like what I was saying with if you have something that has reached like crazy alpha returns and you've made like a killing on it, but you think that there isn't the same kind of growth, keep a big portion of that and then maybe take some of that away, take your winnings, so to speak, and put it somewhere that you might be able to do that again. And this is one of the areas where you see a lot of kind of like tech investments and tech private equity firms where their entire risk, with the way they evaluate risk is like, okay, we're going to invest in 10 companies, 8 of them are going to fail. But the 2 that aren't going to fail are going to make up for the 8 that fail.
They're going to explode. Yeah.
They're going to explode. So we need to get 2 out of 10 right.
Yeah.
And that's kind of how that world exists.
It also reminds me of like entrepreneurship and owning a business. For the first 10 years, 5 years, 10 years, depending on what the business is, the owners and the entrepreneurs don't make an income, right? They
Right.
put all the money right back into the business. And why? Because you reinvest in the business.
Yep.
Every time you have a profit, you reinvest. And you have to treat your portfolio like it's its own business. In a sense it is, right? Even if it's a passive business, it's your business. And the only way to keep it growing is by reinvesting in it.
That's right. And what you're building is your company's net worth and you're tracking your revenue and you're growing the value of your company. And most people that own their own companies, exit strategy one day is to sell their company or to hand it down to someone else in the family as a generational asset. But even a company like Viking, starting out as a real estate private equity firm, it's like a decade before you really start creating the broker relationships, the ability to have access and be able to command from an equity standpoint, being able to work with institutional type players, being on people's preferred lending lists, things like that. And on top of that, in the early going for a private equity firm, it's very fee driven. That's what's keeping your lights on. And once you get into a sales cycle, that's when you're realizing those promotes that have been sitting on the back end of the balance sheet. And that's when it becomes really powerful. So you'll notice that most private equity firms that have been around for 7 to 10 years, the growth from 0 to 10 is minimal, and it depends on how aggressive they are and where in the market cycle they are operating in. But you get past 10 years and you get into like your second sales cycle and like like Vikings at, I think, 1 billion of acquisitions is what they've accomplished this year. We just crossed over into that mark. And the goals would be like over the next 3 years to double or triple that.
Yeah,
and
which is amazing.
you are, because you get into that sales cycle and then you
have the
acquiring
momentum.
the deals that you would expect to acquire, but then you're also, because most of the investors that are invested in the deals want to roll their money in to avoid paying taxes. So when you sell a deal, you have your GP promote, but then most of your LP investors, some of them might want their money back. A lot of them are going to want to place capital into another deal and 1031 it to avoid paying taxes. So you start compounding that. And if you get to where you're selling a few deals and buying a few deals every year, that's when you start on the path towards becoming, an institutional player.
Amazing. Yeah. Well, speaking of multifamily, the last two mistakes that we are talking about today are multifamily specific. I mean, they obviously can diversify into others, but specifically this one. This one is failing to research the market that you're investing in.
Yeah. And I will broaden this. So I think it's failure to research everything involved. So you want to understand
due diligence,
the dynamic. So if you're an active real estate investor and you are buying short-term rental or buying a single family house, then yes, the market is very important. You're going to want to get something like AirDNA. You're going to want to research sales comps. You're going to want to understand how to protect yourself and how to make sure that you're going to be able to achieve the income and cover all of your liabilities. If you're a passive investor, what you're really trying to do is research and do due diligence on the sponsor, making sure that they're being transparent with you, understanding what their reporting packages look like, and understanding because you don't have a ton of control in those deals, you want to be able to look at the model and the underwriting and understand the nuances of the deal. How does rent growth work? How does bad debt work? What is loss to lease? How does that work? What do fluctuations in cap rates do? How aggressive or conservative are you being on expenses or insurance going up and things like that? So I think I recognize that a lot of folks, that's not on the top of mind when they're evaluating an investment opportunity. They're usually looking at an investment summary. Everything looks pretty. All of the investment summaries say the deal is going to do really well.
Yeah.
It's really hard to pinpoint where the risk is. The real reputable sponsors that want to build long-term relationships with you will take the time to be transparent and show you what happens, because ultimately they're saving themselves brain damage in a situation when something goes wrong.
Right.
I would much rather have an investment base that doesn't feel like in a moment of adversity that they were duped.
Absolutely. Well, so that brings me to my last one. So the final question that I have is 2 parts. So the mistake is it's a lack of an exit strategy, but I have 2 questions surrounding this for you. So why is it important to have an exit strategy before even making the investment?
Yeah, I think the biggest reason that you want to have an exit strategy is it helps mitigate risk and it helps you build a plan for what your time horizon is. So if somebody told me that they wanted to invest in my deal that I was promoting and it was a 3-year hold, I would feel compelled to tell them what would need to happen for that to go to 4 or 5 years and what that would mean for those returns and what our thought process would be, because I'd want them to understand that. If they don't ask that question and I don't give that information, the risk is that they could be an illiquid investment 3 years down the road, and maybe they're using that money for their child's college fund. Maybe they know that 3 years down the road, there's some uncertainty. They got their risk profile wrong a little bit. We're going to need that money 5 years down the road.
Yeah.
And if you can't time those exits properly and you're not thinking about them and building a strategy around them, then you're just leaving it to chance, which is never a good idea.
Yeah. No, great. And so the last one is, what factors should investors consider when they're deciding to sell, refinance, or hold on to the property?
Yeah. So I would say, and there's lots of strategies out there. So there's groups that will refi out of a property and get investors their principal back and then leave their money in a deal in perpetuity, and it'll create returns, but they've gotten their principal back. The way that we typically do it is a 3 to 5, sometimes 7-year hold, and you get your returns. That money could get rolled into another deal. I think we feel like, at least when it comes to real estate, there is a ceiling on how much a property is going to produce. So recycling into another deal is more valuable, but you might be looking at other types of alternative investments or traditional equities. With bonds, it's really easy. They're usually a duration. So you know what you're getting, you know what the duration is. And when you take on the proceeds at the end, you'll usually have a plan for where you want to put those. Traditional equities are a little bit tougher because they'll grow over time. What I find is a lot of people are worried about cashing out their stocks. They don't want to pay taxes.
Yeah.
They're like, I just want to leave this here. If I take out like all of these earnings that I've made over the last 20 years, I'm going to have this huge tax burden. So even with traditional equities, I think you should have an exit strategy and know what you're trying to accomplish. What I like about real estate is there are opportunities to offset some of that tax burden. And if you talk to any CPA that's focused on passive income or active income, but real estate focused CPA, what they tell you, like the holy grail of deferring taxes, is that eventually you'll take whatever you need and you'll pay taxes on what you want to spend, but you have built this mass amount of generational wealth, and then you leave it to the next generation and they receive it on a step up in basis and they don't pay the taxes. And that way you have achieved growing your money as quickly as possible, taking on as little risk as you could, and setting up the future generation for having a nest egg that they can build on for the future generation. I think a lot of the way I think and a lot of the way that our investors think is you're investing kind of as a family.
Definitely.
And you're strategically planning as a family. And, one of the guests we're going to have on soon is an estate and wealth planning attorney that we've known for a long time. And she decided that she would be willing to do our podcast with us and help explain, because I have 5 or 6 investors asked me to recommend someone before I reached out to her. And I was like, want to do a podcast with me?
Yeah.
So it is important, and it is an immense amount of money that you're talking about. If over a 10, 15, 20, 25 year period, you're deferring taxes and then leaving it with a step up in basis.
Yeah, absolutely. Well, on that note, I will say that, we've talked a lot about how we are excited for guests to come on our show. So we've been trying to get through the holidays. So we have a couple more episodes that we'll have with just you and I, but we are going to be actively at the start of the year having guests join our show. So we have CPA, economist, we have a trust attorney already lined up for you all. So we're really excited about what's to come in the new year. So please stay tuned and keep listening. We appreciate you all. The last thing that we do ask is that you all reach out and visit the website so that you can submit your questions to us. And I'm assuming after an episode like this, where we have probably brought up a lot of questions, I imagine there's more. I mean, I know we've talked a lot in length about each of the mistakes, some methods and strategies, how to avoid them, but there's probably a lot of nuances in there. People probably heard something and said, wow, like that actually makes me think of this specific investment I'm in, or I was thinking about this investment and how can that investment maybe have risk I didn't think about, or maybe can I avoid that mistake? So reach out, ask us. We're going to do an entire episode dedicated to your questions. It's a Q&A episode. We do have some time on that, but we would love you to reach out to us and submit your questions. So with all of that, thank you for all your time and all your expertise. And we are very happy that you joined us today. Have a great night.
You're welcome. Thanks, everybody.
Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.